want you to go up to the website. I'm going to start, these are the lectures from last semester. And I'm going to start posting the lectures from every class. I'm going to start putting it up there, okay, in that one. And there's an update date, so I update this. What I'll do also is I'll do the announcements over there. I know some of you don't read my emails. You guys need to read my emails. And I will push and distribute the YouTube videos out to you so that you're receiving them and they're also available to you up on the website. Okay. And then if anybody has a problem when you guys are doing the chapter presentations, if you've got a problem with me videotaping the lectures, you tell me and I won't videotape it, or I'll make it private. You just got to tell me. Okay. Some people don't want their videos public. Some people don't want share the videos. I mean, you just got to tell me. Because I like to record all my stuff. And then you guys need to be in teams. Okay. Do you already have a team?
Yes.
3. Teams of 3. So do you already have a team? Yeah. Okay, so you guys are team 1.
Those 2. Yeah.
How many is in your team? How many is in your team? Yeah, perfect. Okay, so you guys are team 1 into chapter 1. And then through the semester on the syllabus, it tells you what team does what chapter. Okay? And then you guys will, you'll rack up points by saying, Professor Sue's going to do chapter 2 and we're ready to go. You spent the last week or 2 or whatever, we're ready to do the chapter. Okay? And then what I'll do is I have the PowerPoint presentations up there. You can basically edit them down and come in and do like a 10, 12-minute, presentation on the chapter. That way I force you to study the chapter and I force you to read it. Because if I didn't require you guys to read it or force you to do it, you wouldn't do it. Okay? I mean, you would. Maybe you guys would. But other people wouldn't do it. Okay? All right. So do you guys have a team? Have you ever been in a team? Have you ever been in any of my classes? Were you in a team in the other class? You were not in a team in my 305. Then how did you do the entrance evaluation work at the end of the semester?
Oh, I have a team last semester.
Yeah, so you were in a team. Okay, are you in a team now?
No.
No. Do you know how to form a team? Do you know how to form a team? Do you know how to build a team?
No.
You don't.
No.
Anybody want an advisor on how you build a team?
Ask someone to be in your team. You need 2 people.
You want to form a team? Okay. Can you form a team right now? Perfect. Okay, you guys are team 2. All right, and you're going to do chapter 2. Excellent. Anybody else have a team? Perfect. You're team 3. Okay, you're going to do chapter 3. Anybody else? You guys got a team? Team 4, chapter 4. Next. You got a team? Got it. Team 5, chapter 5. Okay, that's a really good chapter. That's the portfolio stuff. So it's really good. It's an important one. Anybody else? Let's just see how things flush out first. Okay. So you guys have a team? Perfect. You got another one over there. Maybe one of you guys can go over here. I don't know. You'll have to talk to them. This is an adult class. Okay, so you guys got to form and storm and norm and kind of take responsibility. Okay. All right. So you got a team? Okay. Do you have 3 people in your team? Okay, perfect. So you're in with them and you're in with them. Okay? So you guys are team 6. Team 6. You are with the young man on that team. Yep. So you're team 6, chapter 6. You guys are team 7, chapter 7. Got it? Okay. You're in a team? Got it? Perfect. Got it. You're in a team back there? Perfect. Okay, everybody in a team?
Just to clarify,
Yeah.
you're needing to present whenever you feel we're ready?
Yes.
Or whenever we get started?
you know what, I don't want you coming in and reading from it.
Yeah.
You know what I'm saying? Because like if I said, okay, you know, team 6, there's chapter 6, you know, on this, you know, during this class, what's going to happen is nobody's going to do it until the night before. And then they're going to come in, they're going to read from the slides and the rest of it. Okay? I would rather have you, you know, tell me, Professor Souza, we did chapter 2, we're ready to go.
Okay.
Okay, and then what you're going to do is you're going to rack up extra points by the more chapters that you do. Okay, and there's a certain way to print the chapter slides out that I'm going to show you how to do it. But you got to adhere to the methodology. Okay, so you study the chapter. If you want to bring in outside data or outside stuff, you can do that. But you're going to be teaching that chapter, and you do it when you're ready. Okay, everybody clear?
So the more chapters that we would
Yeah, and in the syllabus it tells you. So what team are you?
7.
So you're team 7, so you do chapter 7.
So if we do more chapters, it's going to be more.
It's gonna repeat. So I already associated the chapters. If you want to go ahead and pick a chapter that you want to do, go ahead and do it right now. And then you can lock in that chapter. Yeah, the more chapters you do, the more points you get. And usually most teams will only do maybe 3, the max 3 chapters a semester. Okay, and it gets easier. And I've already provided you with the PowerPoint presentations, so you don't even have to build the deck. That's all you got to do is read the chapter, coordinate with each other, edit it down, because not everything in those PowerPoint presentations, a lot of it's redundant, and then you just edit the stuff down, and then you talk from the slides, and you teach us. Okay, and you'll learn the stuff really well. Yeah.
When do you have to
Present the chapters when you're ready. Yeah, I don't care. I just don't want you to be not ready.
How many teams were assigned, just so we know the
I
chapters?
think we had 7, right?
7?
7 teams? Yeah. So there's 7, and then, so I've already allocated the first 7 chapters. Now you can come to me and tell me, you know, these are the other 2 chapters we want to do. We want to do hedge funds, and we want to do, you know, derivatives. Or we want to do, you know, intrinsic valuation of stocks. So we want to do the fixed income chapter. Whatever you want to do. So you get to pick whatever one you want. Okay?
How many chapters are there?
I think there's like 22 or something like that. So there's plenty. Some of them are easier than others. How? 20. And the last one is what the CFA, it's like the CFA ethics. It's not really a content, it's just an ethics chapter. So you can do it if you want, but that's pretty easy. Right? I love the chapters with the math in it. Because you're all finance majors, and I know you all love math. You gotta love math. Okay, good. So let's, does everybody have the course website up? You gotta pull up the course website. And put it in this view too. So it looks like this. What I want you to do is I'm going to go through this again. You see those stock portfolio reports up there at the top? Those were from 2 semesters ago. The stock portfolio reports that we did last semester were really good. Okay, so I'll make those available to you. I'll probably get them scanned and then post them up there so you can see what the content is. Don't plagiarize from there. You can use it as a template, but do the analysis and then use the template to update the data based on your analysis. Okay. Did you guys get the calculator primer that I wrote? Did you get a copy of that? So I did the HPs and the Texas Instruments, and basically pulled out the, you know, how to calculate net present value, return, stuff like that. Did everybody get copies of the memos? The memos. Test question. I'm going to ask the question again. Did everybody get copies of the memos?
Yes.
No. So who didn't get copies of the memos?
We saw them, and I thought you said.
Oh, you know what? I had them on the copy machine.
Oh, got it.
So these are the ones that I stole off the copy machine. Do you remember these?
Yes.
Yeah, she's an expert at these memos. How many times do we go through the memos? You and me. How many? A lot of times, okay? A lot of times. We went through a lot of times on these memos. And why did we go through them a lot?
Always have some problem.
Yeah, you always had some problem. What was the goal? What's the goal for these? What?
Perfection.
Perfection, exactly. These things need to be perfect. Okay? If the graph is in the margin over here, and you look at it, what are you going to think about it? It's like the graph is all, one graph is really big and the other graph is really small, the other one's in the margin. What would you think about these numbers? Not very good, right? Because there's errors in it. So if there's errors in the formatting, there's going to be errors in the data, in the analysis. So we spent a lot of time, didn't we? Yeah. Parts memos were really, really good too. These were awesome. Really good, really high quality. I think we even used yours. Oh, look at that. Look at, they're yours. That's amazing. Yeah. Okay. And then here are the, this is an example of, Rebecca was the student that I gave the flowers to and the chocolates to, for obvious reason, right? Because this is her product. This was her deliverable 3. This was the comprehensive product that her and her team delivered to me at the end of last semester. Is this thing just awesome? Yeah, it's brute force, right? It's gonna do something. This thing's probably worth like 25 million bucks. Okay, the analysis, the content, the presentation, it's amazing. Take a look at it. You know, if you take off the rubber band, put the rubber band back. Don't mess it up. Okay, I don't have any problems with taking pictures of it. But do not mess this up. Okay, because I'm going to give it back to her because she deserves it back, right? Because she's going to use it to get her investment banking job there. When she Exxon Bank or some equity firm. I don't know if she's going to stay here from Vietnam. But amazing work, right? Beautiful work. Here are some other examples of the active portfolio. This is another one. This is the passive portfolio that you're going to produce. Here are examples of the presentations you're going to make. You're going to make three of these portfolio presentations. One for the passive portfolio, one for the active portfolio, and one for the all 3 of the portfolios. You're going to do 3 portfolios.
Was that just one deliverable or 3?
It was she submitted, that was the final deliverable.
The last one. So
That was the last one, that was the comprehensive. Yeah, because you don't go to, hers were individual portfolios that she had done throughout the semester, and we had worked on correcting it, so that by the end of the semester, her product was perfect. So it was a series of reports that had been worked on, corrected, and built on over the semester, and then that was the final product that she produced at the end as a comprehensive delivery. Okay. Does everybody make sense? Does that make sense? Yeah. All right. And then what we should be able to do is I want to do these too, because there's a whole chapter on stock valuations, right? And maybe because you guys are, maybe we can have like 2 or 3 teams do one stock and 2 or 3 teams do the other stock. And then what we'll do is we'll go through the valuation in class. I'll show you how to do some quick and dirty evaluations, and then we can put together these pitch books so that you'll have this in your quiver to show potential employers too. So that's a really good one too. What I like to do in my classes is I like to give out the products so you can see the best ones, so you get an idea of the analysis, but really the focus on not only the analysis. Students think that this is the way it usually works, because I oversee the CFA challenge teams a lot. And what they'll do is they get into the analysis, and it's like, I work so hard on the analysis that I really don't need to focus too much on the report or on the presentation. The problem is that if your report and your presentation are really good, actually the judges will overlook some of the analysis, the weakness in the analysis. But if the analysis is really strong, but your report has defects in it, the formatting and grammatical errors, the presentation has flaws in it, they grade pretty heavily on the actual quality of not only the presentation, but the quality of the physical presentation and the quality of the physical report. Okay. And anybody who wants to go on and work for a bank or a private equity firm or a hedge fund or an investment bank, a real estate investment trust, or one of the big four accounting firms, you cannot have flaws in your production, in your reports. Okay? And you're going to be working closely and back and forth with the managing director to make sure that the product that you produce is of the highest quality. Okay? And that's the way it's done. Okay? So in school, you guys have all been brainwashed to do work, hand it in, and then the professor gives you a grade. Right? And if you get an A, that's awesome. But there's no D's or C's or even B students in the corporate world. Okay? The top people are all A students. So by grading you a C and then moving on and not working with you to correct your material so that you can reproduce it at the A quality level is not good. Okay? That's not the way we do it in the world. So I don't know what they do. I know why they do it in academia, because it's just easier for them to just grade it and give you a grade. It's harder in the real world to go back and forth to make sure that it's perfect, and then your work's perfect. Okay? And that's basically the standard. That's the way it works. Okay? So I will work with you, okay, to make sure your work is really, really good. Have you guys used, and you're going to have to hand in your resumes with every deliverable. Do you guys use the Career Center? Have you gone to the Career Center?
Yes.
Yes. Have you had them look over your resume?
Yes.
Perfect. Does everybody have a resume? Do you have a resume? I know you do because you did it 4 times in the last class. Do you have a resume? You have a resume? No, okay. Will you go to the Career Center and work with them to do a resume? Will you go there and have them start working on it? Anybody else not have a resume? Does everybody have a resume? Do you have a resume?
I have a resume. Mine has designs on it, not like the classic.
You probably want to have 2.
I'm sorry?
I have 2.
Two?
Have a classic one and then have the design one. Okay. So you have 2, depending on who the employer is and what their criteria are will determine what resume you use. Okay, so how many people have a resume? Raise your hand. Okay, she's working on one. Yes, sir.
I need
Do you need one? Will you go to, you need one? Yeah, will you go to the Career Center? And you can even take a picture of these. All right. Who else doesn't have a resume? Okay. You don't have a resume?
I don't.
Oh, yours is going to be perfect. And once you guys get a draft of the resumes, I want to show them to me as soon as possible. I mean, Sharon and I went through this today. Yours is in really good shape. I know Parth is in really good because he was in my last class. And how many times did I go over the resume with you? 7 times. Okay, I went over his resume 7 times. Okay. Until it was perfect. All right. So you guys got to do the resumes. You're going to need a resume if you go to grad school. You're going to need a resume if you do internship. You're going to need a resume if you educate. And I know the Chinese resumes are different than the American resumes. So do one of each. Okay. I won't be able to read the Chinese resume, but show me the English resume. Okay. Yeah, because some of you may be going on to Oxford, or maybe going to King College, or Trinity, or something like that in the UK, and you're gonna need a formal resume, and you're gonna need a letter of recommendation. All right. So how are we doing? Is this good? You guys interested? Is this gonna work for you guys? It's kind of boot camp, isn't it? It's like the Marines of finance, right? And I won't make you get down and do like 100 push-ups, right? Okay. Everybody get a copy of the quiz, the take-home quiz? Did you get a copy? Now the quiz is really easy, but it's really hard. So it's hard and easy. The easy part, does anybody have a book? Did anybody buy a book? Do you have one? What? Yeah. The quiz, did you guys get a quiz? Okay, everybody got a take-home quiz? We have some people here that weren't here last week, so we need to bring them up to speed pretty quickly. After the cover page, it gives you the total instructions. Okay, what you want to do is get some binder paper, not with all that frilly stuff on the side, but a nice stack of binder paper, and you're going to take the book. Okay. You guys who weren't here, you need to focus on me. So what you're going to do is you're going to take the book. You're going to read the questions, you're going to read the book, and you're going to write out the answers to the questions in the table. Okay? So it's like a self-study course. It's like a correspondence course. Okay? Yes, sir?
For the quiz, there's some questions where you don't have so you just put it on binder paper and then you kind of attach it to whatever page that is. So for example, page 1, there's a lot of questions, there's no space.
Yeah. So that's why you're going to write it on binder paper.
Okay.
Yeah.
And then just staple it onto that.
And then what you're going to do is when you're done, you're going to take the written quiz, you're going to stick it on top of this quiz with a cover page, and you're going to flip it together.
Okay.
So all the things that you deliver in the class will be separate deliverables. So maybe somebody asks you, hey, do you have any work that you've done in class that shows that you understand portfolio construction? Yeah, we did a take-home quiz, but I wrote everything out. But I have really nice handwriting, so you can read my handwriting. And let me just show you, here's the stuff that we went through. So, the employers will take this stuff. The quiz takes about 8 to 10 hours to do. And it's not due for another 3 weeks or something like that. So you have basically plenty of time. And I think my students last semester said they would just hack out an hour a week and just work on it and get it done. I don't mind if you work in groups to do it, but if you do work in groups, you need to stop. Once you're done with it, then read it 2-3 times. So you're memorizing all the content and you're learning all the material. Because we can't go through everything in the book, but the book sets a nice foundation in a lot of the language, in a lot of the logic in which I communicate in class. Some of it's new, but most of it is consistent with the book. Okay? Yes, sir. So the book's a good reference. Okay.
So, just to clarify.
Yeah.
So when we do the quiz, we just write it on.
Yeah, you get a stack of binder paper, and basically you start writing out the solutions.
What's the binder?
Does anybody know what binder paper is?
Okay.
Yeah, that's binder paper. Yeah, but do me a favor when you hand it in, and we'll use this as an example. A lot of my students like to give you, they go like this. And they start putting it together, right? And then they'll staple it together and they'll give it to me like this. Right? With all this stuff right here. It's like, I don't want this. Would you give this to your boss? Would you give that to your boss? No, you're not going to give that to your boss. You need to slowly pull the stuff apart, right? So that it's nice, you know what I'm saying? Make it look good, okay? All right, so, all right.
Professor, one more question. So the blue book is just for notes.
Yeah, you guys didn't get the blue books. So like the first, I don't know, how long have we been in class, like an hour or something like that, 40 minutes? What I did was I handed out blue books, okay? Last week, right? So on the front of the blue book, you write class notes, right? With your name and the class and everything on it. You write, did you do this in my last class? Yeah, did you write class notes in the blue book? Yeah, so why do I give a blue book? Why do I give out blue books? To write the class notes in. Why do I give you blue books to write the class notes in? To write notes. Perfect, exactly. So that you write notes, right? And then what are you going to do with those notes? What are you going to do with the notes? You're going to study from them, and you're going to then give them to me, so I know that you wrote them. No, you're going to give them to me. There's 3 deliverables in the class. So whenever deliverables is due, you're going to give me the notes, so I can see that you took notes. And test question, do you want to write more notes, a lot of notes, or little notes? Do you want to write a lot of notes or little notes? A lot of notes. Okay. So when I was in my classes, when I was going through my program, my goal was to write 20 pages of notes every class. Whatever my professor said, anything that was on the board, I was constantly taking notes. Okay. And then when I noticed that my other students, when they write notes, and I ask a question, what's CAPM? They start going through their notes. Risk-free rate plus beta times the return on the market minus the risk-free rate. Perfect. So the notes were right there for them to reference. Okay. If you don't have notes, what do you do? If you didn't write notes and I ask you what CAPM is, what do you do? What? What?
Look it up.
Yeah, you can look it up. Is it faster to look it up on the computer or faster to look it up in your notes? Okay. If you write out notes, are you going to remember the material more or less than if you typed it or if you looked it up on the computer? You're going to remember it. So that's what I'm trying to do is to create permanent knowledge of the finance, not intermediate, short-term knowledge to do well on an exam, but to create permanent knowledge so that when somebody asks you a question, the answer flashes in front of your brain 3, 6, 10, 15, 20 years from now, because you memorized it in long-term memory, okay? I know it sounds tedious. A lot of my students complain that a lot of the stuff that they do in my class is busy work. I don't look at it as busy work. I look at it as creating permanent knowledge. Okay, that's really the goal. Did everybody get their blue books and stuff? Make sure you put your names on them, of course, and make sure you write class notes on it. Okay. What else? Oh, did anybody not get the syllabus? I get complaints about my syllabus. It's like 32 pages. Everybody complains. Professors complain. Everybody complains. There is a contract in the syllabus. Okay? If you read the syllabus, you saw the contract. Okay? The contract, what is the contract? What does the contract say? Everybody get a syllabus? Yeah, you got it. So, what does the contract say? Basically says, I will come to class, I won't use technology other than for class, I won't, I'll notify you if I'm not going to be here, I'm not going to plagiarize, I'm not going to steal stuff, I'm not going to cheat, that stuff. My classes are set up where there's no incentive to cheat, right? Because it's all based on work, right? And if you work hard, you'll get the grade. If you don't do well, then we work together and we correct it and make sure that it's really good. Okay? So there's no incentive. I designed my classes so that they're cheat-proof. The only reason why you would cheat in my class is because you are a habitual cheater and you feel like it's a conditioned response. You basically trained yourself to think that you need to cheat in all of your classes. That's why I find it's just crazy, because I find these people who cheat, and it's like you didn't even need to cheat. It's like you cheated because you've been cheating, you know, for the last 4 years in your program. You feel like you have to. You don't have to. If you can't do the work, you need more time, you tell me, we'll work it out. Okay? You having problems, you're stuck, you're confused, you come see me, you call me, you text me, you write me a letter and mail it to me, you send me an email. There's no reason. Right? I'm not here to hurt you or penalize you. I'm here to reward you for your efforts. So my classes are totally different. There's not penalization, it's reward. Okay? And then we work together as a team, like you would with any other managing director in the corporate environment. What else? Did I have some pre-tests? Pre-tests? Anybody not get a pre-test? 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 Pre-test. Okay, I think I ran out of pre-tests. Oh, is there an extra? Oh, there's the quiz. That was the pre-test. I think I have. How many people started the pre-test? Awesome. Can you show it to me? Yeah, just look it up. Just look it up and show it to me. Awesome. Awesome. Look at that one. That's freaking unbelievable. Go ahead. Yeah, why don't you just show it there? Show it there. Who hasn't started on the pre-test? Okay. You guys got to start on the pre-test. Okay. And then you guys, so next week you guys got to show me. Okay. I know you can't do the last part of the pre-test because we're going to go over that. And the pre-test in this class is the quiz in 305. Okay, so I cram everything into the pre-test. Okay. Yes, sir.
So the pre-test is not in the stuff is not in the textbook.
No, it is. There is some, yeah, totally. Like the two portfolio standard deviation calculations using the covariance and correlation is in the book. It's in the book. Systematic risk and unsystematic risk is in the book. Variance, covariance, standard deviation is in the book. A lot of that stuff's in the book. If you get to a point in the pre-test where you can't answer the question, skip it. A lot of the quantitative analysis, the statistics, the visualization, that stuff's all easy. Balance sheet, income statement, easy. Financial ratios, easy. Okay? So a lot of that stuff you already have in the book. Okay? The only stuff that's not in the book that you're not going to get that I'm going to have to explain is how you build forecast models, regression, time series, cross-section. How do you build forecast models? Do you think that you're going to be asked to build forecast models? Yes, exactly. Do you guys know how to build forecast models? I mean, maybe quantitatively, because in your quantitative class that you took, you probably did time series regression. Yeah. Is time series regression a forecast methodology? If you use time series regression, can you forecast the dependent variable? If you've already forecasted the independent variables? Can I use time series regression as a forecasting method? Can I use time series regression as a forecasting tool? Yes, got it. Excellent. Yeah. See, what I do is, this is how I drive my students crazy too, is I ask the questions over and over again until I get an answer. And I ask them over and over again until I get the right answer. Okay. It just tortures them. But I think it's a good teaching tool. Statistical pretest. Memos. quiz. Okay. Do you guys think you have enough to do? Yeah. On top of everything else. So let's go through some stuff on the course website. So I will post the videos up there. That's from last semester. I even have the midterm and the final already posted up there, but I took those down. Actually, the quiz is really hard. It takes a long time, and the midterm is easier and has more content, so you just read through it and then answer. And then the final is really easy. It takes like an hour. You're just reading more of the content and then filling in some of the gaps. Okay. Syllabus is there. This is all redundant. When am I available? Yeah, but can you get a hold of me at any time? Yeah, can you text me? Can you call me? Yeah. I know your generation doesn't call people, but it's a really effective method. Just pick up the phone, all right, Professor Sousa, hey, I know you're busy, will you give me a call back? Hi, hello, how are you? What's the problem? Boom, get the thing done in like 30 seconds. You text me, email me, I'm driving, texting at the same time, trying to send emails. It's just easier sometimes to just, I got my headset in.
I texted you last Friday, you didn't reply.
I did it?
Yeah, I did.
Oh. Your text was like that long.
Yeah, I want to be
Right.
detailed.
Right, but it wasn't a quick answer, was it?
But you didn't reply.
I know, but I was thinking about it. It's like, I can't reply to this. It's like, it's too
days.
long. It's too
It's
long.
2 days.
You came in and saw me, right?
Yeah.
Yeah.
Okay.
Okay. Yours is a different situation. That wasn't about the course. You were asking about career coaching and really psychology around your club. Okay? So that was it wasn't a career, it wasn't about the class, it was something a little different. Right? So, yes, I apologize for ghosting you. I'll never do it again. Okay. So let's go through this here. Does anybody love economics? How many people like economics and finance? How many people like it? Everybody else doesn't like economics and finance, and you're basically a finance major? Interesting. Fascinating. There are some amazing, here we go. So, there's the movie review worksheet. You guys are gonna need that. Did I hand that out? No, okay, I still have to do that. Okay, and then you're gonna do 3 movies in the class. And then you're gonna fill out the movie review worksheet. Okay. You already have them from last semester, so don't make them go through the movie, or watch the movie again, you probably learn something. The Inside Job is really good, The Big Short is really good. I would watch the Inside Job first, and then The Big Short. Big Short's fun, Inside Job's depressing. But it totally tells you exactly what happened leading up to the financial crisis, what actually occurred, and why we're living through basically post-financial, crisis, economic and political reality. Things just don't happen for no reason. You guys are living in a global, political, economic environment that was directly related to the financial crisis and basically the corrupt institutions that basically got us there, and the corrupt institutions that basically continue to govern the geopolitics on a global basis. So will the financial crisis happen again? If the corrupt institutions are still in place, and there wasn't regulatory reform or reform to basically clean up the corruption, does that make it probable that it's going to happen again?
Yeah.
Yep. And if it happens again, in maybe 3 or 5 years from now, are you guys going to be in the workforce at that time?
Yeah.
Are you going to want to know how to navigate it
Yeah.
so that you don't get fired like I do every single recession and have to go out and find another job?
Yes.
Yeah. And you guys are going to be working in finance. You're going to be risk and investment managers in a geopolitical environment that's more risky, more volatile. So you're going to have to be better managers than me, okay? Because you're going to be doing it longer than me in a more risky environment. So So down here, I also have other videos, okay? Wall Street conspiracy, all of these links to, all of these other movies, and Noam Chomsky up there, amazing. Ghost Exchange, Margin Call to the interviews by Charlie Rose, Michael Lewis, Joseph Stiglitz, who's coming in like, a week or two from now, is going to be speaking. You guys got to go listen to what he's saying. He's one of the most prolific speakers and really critical and honest about democratic capitalism and the failure of capitalism and the financial system. Alan Greenspan, Paul Krugman, Noam Chomsky a couple times. You should watch the videos by Kyle Bass. Kyle Bass is a hedge fund manager. He's freaking brilliant. He understands psychology, sociology, politics, economics, finance, accounting. Finance is investing is multidisciplinary. You have to know a little bit about everything: psychology, sociology, politics, government relations, public administration, psychology, organizational behavior, technology. This guy's amazing. Go listen to 20 or 30 minutes of how he speaks. Listen to the way he speaks. Okay? That's why he's a multi-millionaire. He made like $250 million shorting the housing market in the financial crisis. And he's a macro trader. Okay? He looks for basically macro trends. So he's been shorting, Japan and China for quite some time. Okay? So he's lost some money. He had to unwind the short positions because the central banks in China and in Japan just kept reflating the asset prices. So the assets really never dropped. So he had to unwind his short positions. But you can't keep inflating and reflating asset prices forever. At some point in time, either your sovereign bonds go into default or the Federal Reserve pulls back on liquidity and the markets go into convulsion and you go into a severe financial crisis and a recession. And I'll walk you through some of those cycles. So there's a lot of really good videos here. If you guys are into finance, if you're into this stuff, you need to watch some of this stuff. Okay, what else is on there? There's some lecture series here. Okay. Here's the statistical pretest. Okay, I already gave it to you. Right? And you can fill out the statistical pretest right there on the worksheet. And then I'm going to go through the last part of the statistical pretest. Here are some resources that you can use. You can also use the book. You can use the internet. You can use whatever you want to fill out the pretest. But I put in some statistical resources for you to fast track. I also provide some training videos in macroeconomics, monetary policy, microeconomic statistics, advanced probability statistics, calculus, matrix and linear algebra, time series forecasting. Do you think you're going to need to know this stuff if you want to go on and work as a trader or risk manager or hedge fund manager or any of that stuff? Some people want to go on and become financial engineers or quantitative finance people. You got to know the calculus, you got to know the matrix algebra, you got to know the mathematics.
Do you teach econometrics also?
I do.
Okay.
I do. But I did a lot of econometrics in my master's degree in economics, and then I did a lot of advanced stuff. In my doctorate program, there's a whole course on different types of statistical methodologies, and actually a lot of the content from the statistical pretest was taken from my graduate and undergraduate programs, but it's consistent with the undergraduate curriculum. Okay? So I'm not just making this stuff up. Actually, but I threw in these videos for people who want to know more about quantitative finance, quantitative data analysis. The top people that are getting the best jobs right now are the people who double majored in data analytics and finance. Or people, what they do is they get their undergraduate degree, they go and do their data analytics degree within the first 1 to 3 years. Once they're out, they get the CFA certification, and then they basically, with their GPA and their work experience, they go do an MBA with a concentration in finance at one of the top schools. Or you go do like the MFE, the Masters in Financial Engineering at Berkeley. Or you go do a Masters in Quantitative Finance at NYU or Columbia, someplace like that. The combination between the two is now finance and technology have now converged into a new area called FinTech, or finance technology. So it's between technology and finance. And these technology firms are creating financial tools and techniques and products, and so they're basically just startup companies with engineers that know how to build product, and then they use the technology and the data programming to basically implement the strategy or deliver the product in the process. And I would say that I'm a financial engineer to a certain degree, but I don't engineer the products. I advise on product attributes. I'm more the project manager or the program manager, product development manager. I usually manage teams of developers, the designers, and then the data scientists and the programmers. And I communicate not with them, I communicate with the CTO, the Chief Technology Officer. And then I work at the principal level, developing solutions for clients. Okay? Just to kind of give you an idea where we're going here. All right, here are the memos, the examples already handed those out. I'm going to spend a lot of time walking you through not only what it takes to produce these memos, but also the finance and the economics behind the memos. Okay? When you read them, they look very simple, but they're extremely complex communication devices, instruments, that basically communicate your recommendations based on your view of where you think the markets are going to go, and you're going to make derivative trade recommendations to the proprietary trading units within our company, but also to your institutional and qualified clients, people who can handle derivative trading. Okay? So we're going to do that as soon as possible. The homework, they get questions about the homeworks. The homework has been assigned. Okay? It's not due. It's due when the deliverables due. And I would like to see a package of homework submitted to me. The homework is really easy. You go up, it basically tells you what problems you need to go get from the worksheets, and then what you do is you go study the worksheets and you study the programming in the Excel. And then what you do is you print out the worksheets, like you would be giving to your boss, and then you assemble the homework with the cover page, all clipped together, boom, handed to me. Okay? So I'm not making you do a lot of homework problems. I'm making you go through and review the homework problem solutions. Because I figure instead of having you crank your brain on how to solve this frickin' problem, it's like, show me how to do it the right way the first way. And I'm going to go study the solution. Not only the mathematical solution, but also the programming solution in Excel, looking at the macros. And what I would do is I would download all of those Excel spreadsheets and put them in a file. Because you may, wherever you go in the future, you may want to reference those Excel worksheets, okay, to quicken the process. Either developing out that Excel spreadsheet, because the template's already been made, now you're going to develop it out, or you can use the template for whatever it is you're doing within your job. They've already developed. Okay. All right, so did that answer the questions on the homework? Philosophy there? So if there's websites you got to go to the website, start printing out some pages. If there's homework, assignments, actual problems, go to the solutions page, write the solutions out on a binder paper, so you can see how to solve it. Okay? Because when you're taking the CFA exam, and you're taking the CPA exam, or you're taking the bar exam, or you're taking the real estate exam, the insurance exam, the annuities exam, if you're taking any of these standardized tests, the way that you pass those exams is you memorize hundreds of problems and solutions. So that when you sit down to the 150 questions that you need to take to pass the Series 7, I've already memorized the questions and the answers for 2,000 questions. So I'm going to know, I'm going to be totally familiar with any problem that's going to be on the exam, and I'm going to pass the exam. What's the goal? What's the goal when you take the exam? What's the goal? To pass the exam. If you pass the Series 7, what can you do? If you've got a Series 7, you're a registered rep. What does that allow you to do? You can sell securities. Can you sell securities without the Series 7? What about if you pass the real estate exam? What can you do? You can sell real estate. Can you sell real estate in the state of California without a license? Nope. Can you practice law?
Yeah.
Nope. Can you be a certified public accountant in the state of California without passing the CPA exam? Nope. Can I sell life insurance and annuity products without a life insurance license from the state of California? Nope. So certifications, licenses you got to have if you want to sell product, in this business. All right. So I'm giving you some crash course here. So here's your templates. Solutions to homeworks, solutions to the templates. A lot of my students, what they'll do is they'll go to the problem, they'll look it up on the Excel spreadsheet, they'll go print worksheets, and it'll print out like 100 pages. Okay? And then you'll have one piece of the table will be distributed across like 7 pages. So they don't even know how to print out a table, landscape or portrait in Excel. Okay? And if you can't do it, I'll show you how to do it. Okay? But let me know. If you don't know how to print in Excel, if you're not comfortable in Excel, I'll work with you or work with somebody that can train you in Excel. Okay? Because you got to know. This is the first thing they ask in your job description. Attention to detail, Excel skills. Okay? They're like the 2 things. Portfolio analytics, spreadsheets. Yes, we're there. Okay, this is awesome. Okay, you want to download these because you're going to use these as templates. And I'll have some updated ones too. So these are the best versions that I have right now. These are the spreadsheets that you're going to use, okay, for the semester. And some of them you're going to have to reprogram a little bit, okay, because there's a few errors in some of them, but they're actually all in really good shape. Okay. Who are the portfolio managers? Who are the portfolio managers? Raise your hand. Raise your hand, portfolio manager, got it. Who's the portfolio manager in your group?
I guess I would.
It's got to be somebody who can manage the group. Can you manage the group?
Sure.
Yeah, do you know Excel? Perfect. Got it. Who's the portfolio manager in your group? Okay, who's in your group? Are you 3 together? Yeah, you'll be the portfolio manager? Awesome, perfect. Then who's the portfolio manager in your group? Okay, your group? You're not gonna have one, why do you need a leader in the group? What does the leader do?
Make sure everyone's on track.
Exactly, make sure everybody's on track and they have a global perspective. Okay, the portfolio manager is not only going to understand the portfolio construction analytic part of it, but they're also going to be working with the fundamental securities analyst and the technical analyst. And the technical analyst is going to need the fundamental securities analyst and the portfolio manager. And the technical and the fundamental securities analyst is going to need the technical and the portfolio manager. You guys are going to be working in a team. Okay, but you need a specialist and you need of each function, but you need a leader to make sure that you're on track. Okay, who's your portfolio manager? Awesome. And then who's your portfolio manager back there? Yeah. Okay, perfect. Got it. Who wants to be the technician? The technical securities analyst. Perfect. Technical securities analyst. Perfect. Yeah. And who's going to be the fundamental securities analyst? Okay, so does everybody have a role? Does everybody have a role? Okay. Yeah, I'm trying to get this stuff done, right? Because you guys are going to be working really closely with me, and you're going to be working really closely with your teammates, and you're going to be working really closely with other teams and other individuals in the class. okay? It's a total corporate simulation, okay? It's a corporate simulation, right? This is the way we do it in the real world. If I have a problem, I make an attempt at it, I work in a team to accelerate the process, and if some other team or some other individual within the course has reached that milestone, that individual is basically responsible to train the others, to bring them up. Nobody's left behind in my classes. Everybody gets there. Everybody goes there. So if you don't come to class and you struggle, and you're not communicating with us, I'm going to find out that I'm going to have to go work with you. I'm going to have to bring you up. So I'm not going to let you fail. All right, so let's go through these pretty quickly. Everybody's got a computer. Everybody's on the course website. Start pulling up the spreadsheets. So I can walk you through really quickly. Because what I want you to do as soon as possible is to build a portfolio. Okay? Does anybody know how to build an equity portfolio? Does anybody know how to build a portfolio? Has anybody built a portfolio? Anybody build a portfolio of their own securities? Anybody invest in exchange-traded funds or mutual funds that are basically predetermined, standardized portfolios with risk-return characteristics to them? No? I'm going to teach you. You got it. Okay. So we're going to do. All right, just did you pull up the first spreadsheet? You guys got it all up? So everybody needs to come up and great pull it up. Do not sit in my class and do nothing. Okay? You got to be doing something in my class. Writing, researching, searching, auditing. You got to be doing something. If you're not doing anything, then drop my class. Okay? I'm going to push you in my class. You're going to learn more in this class than you did in your whole program. Okay? Because this is a graduate program, crammed into an undergraduate. It's everything I've learned in the 5 master's degrees and the doctorate. I'm working on my own. Okay, does everybody have it up? Do you have it up? Okay. So I'm going to need you to go find 25 stocks and build a portfolio. What's the first thing you need to do? If you're going to build a portfolio of 25 stocks, what's the first thing you're going to need to know? What do you need to know? Do you just pick randomly 25 stocks? No. What's your objective? One could be diversification, exactly. Okay. Do you have to have are you going to put together a stock portfolio, diversified portfolio, maybe 3 or 4 sectors, diversified, that's going to return 2% over the next 10 years? No. What's the target rate of return for your portfolio? Yeah, 8 to 10%. Because under the rule of 72, if I can get a 10% rate of return annualized for 10 years, what's 72 divided by 10? 7.2. So I can double my portfolio in 7.2 years. So basically, if I can get my clients 8 to 10% rate of return with diversification, I can not only give them diversification, but I can double the portfolio in less than 10 years. That's all everybody wants. And if you're going to give me 20% rate of return, I bet those stocks are a lot more risky, and I don't want 22% at a very high risk. I want 10% at relatively low risk. And if you're going to give me, high returns, I know there's going to be high risk there. So that's a different type of investor. Okay? There's some investors that are extremely risk averse. There are other investors that are risk averse. There are other investors that are risky. They just care about return. And then there's other investors that are opportunistic. Those are the investors that are looking for deep, deep discounts in their stock prices. And they do the analysis, they pick, and they put together portfolios picking stocks that are significantly undervalued. Okay. So do we have it? So I'm building a portfolio. It can be concentrated, it can be diversified. What else? What else do I need to know when I'm designing a portfolio? Yeah, but let's talk more philosophical. You know, what's the first thing you have to do when you start to build a portfolio product?
Industry?
Yeah, exactly. Do I want one industry? Well, I'm just saying, I could have one industry, and I could say, okay, I want to invest all in 25 tech stocks, all small cap. So that's very risky, right? It's all in tech, and it's small cap, so there's going to be a lot of volatility in that portfolio. I could do, you guys should be writing notes. I could do, because I'm basically laying out the portfolio strategy for you. And before you build a portfolio, you got to have a strategy. Okay? So one way to do it was to say, okay, I'm going to do all tech, and I'm going to do just small caps. Now, what's the problem in investing in small capitalization tech companies?
Very risky.
They're risky, but what's the other problem?
They all like go up and down the same.
Yeah, there's a lot of volatility, but there's a problem.
Not enough liquidity.
There's that, but there's not a lot of something for a lot of these smaller tech companies. There's not a lot of data. Okay? Because a lot of them may not have been around the last 10 years. Okay? So you have data limitations. We can get around data limitations, but that's like a really risky portfolio. What if I invest in tech companies, but mid-cap companies? What's the characteristic of the portfolio? One industry, mid-cap. Does everybody know what mid-cap is? Mid-capitalization. They're not super big, multi-billion-dollar market caps, market capitalizations. They're mid-sized companies. Okay. So what is the risk profile for mid-sized companies? Are they as risky as small-cap companies? No. Okay. Is there going to be more data? Yeah, most of the large-cap companies have been around, or mid-cap companies. And what if it was all tech, all large-cap?
Lots of data.
Yeah, lots of data. What about the risk characteristics? Less risky. But you're also taking on risk because you're all in the tech sector. So some of my students have said, you know, I don't want to do all tech, but I want to have some kind of tech component. So I'm going to do some tech companies, one industry. I'm going to do medical tech companies, and I'm going to do defense companies. Because defense companies like Boeing is really a technology company. They basically build weaponry, but they do a lot of other stuff too. Okay. So you can still be in tech across different sectors. You're getting sector diversification, okay? But your theme, your philosophy, your style is still in tech. Okay, so that's a good one. Another one would be like consumer durables, consumer-based portfolio. So I got, you know, car manufacturers. I got online shopping companies, and I got traditional, you know, retail stores, you know, and maybe some lodging, you know, in there. So it's more consumer based. So the question is, the sectors that you pick, the companies that you pick, particularly the sectors that you pick, are they discretionary spending, or are they stuff that you need, like Johnson & Johnson and Procter & Gamble, stuff like that. So you have to think through your style of your portfolio, and then decide what your portfolio style is going to be, what the philosophy is going to be, what the sectors are that you're going to be targeting, and what your sector mix, and then within each sector, you're going to pick the best companies. Okay? And you can Google that and stuff like that. Do you think that the large companies within the sectors are large for a reason? Or did they just happen to get large? They're large for a reason, right? They understood the competitive market space, they understood their clients, they could basically build and deliver and distribute products with the product attributes that solves the problem for those clients, And they were able to do it consistently over and over and over again. And then when they ran into constraints where they couldn't grow fast enough, what did they do?
Acquired?
What?
Acquired?
They bought other companies, exactly. Cisco, Salesforce, IBM, all those guys. If you can't produce the product fast enough, you go buy it from somebody else. If you can't build it, then you buy it. So an easy way to do it is you come up with your portfolio strategy, either by concentration or diversification, and pick your sectors and sector allocations. And then you go pick the best companies you think are the best within that sector. Or you pick companies that you think the stock price is going to go up over time because you've been following them. You know, how are you going to do it? How are you going to build it? And the best way to do it is to go find exchange-traded funds or mutual funds, or talk to people that actually build these things and ask them questions. How did you do it? What was the product that you built? Why did you build it like that? What was the target customer or the target investor that you were trying to target that would buy those exchange-traded funds or those mutual funds or give you money to invest in those securities directly? Okay? So you need to have written that down, okay? Because that's the crash course in portfolio construction. Now here's the first thing you need to do is build a static portfolio. Now this worksheet is very simple, okay? But students like to make this worksheet really hard, okay? Because they go in and they start messing with the formats. They start messing with the columns, messing with the rows. They don't follow instructions, so they end up screwing it up and they gotta go back and redo it, okay? And we're gonna use this template over and over again in the course to back test your portfolios to see if your portfolios do what? What?
Perform well?
If they perform well, and then the second is, do they do what? We talked about it right in the first part of the class. What are we looking to do? Beat the benchmark, and we're trying to generate what? We're trying to generate alpha, exactly. Got it. Okay? So it's really, really easy spreadsheet. And what I would do is I would go through and audit the spreadsheet so you can learn how it's all linked together. Okay? Are you guys all good with Excel? Yeah, well, you know, you will. Just practice, practice, practice. So let's go through this. And I'll walk you through how to solve this, okay, right now. And I'll try to go through these Excel spreadsheets. I'll probably go through them like 3 times. And then I'll work with you on a one-on-one basis to audit them and make sure that they're calculating correctly. And that the results are coming out. So here's the first thing that we did. I'm going to shrink it up a little bit. So the first thing you want to do is go to this master target portfolio. Oh, look at that. I actually have instructions. Oh my God, does that make things easier? I totally forgot I actually have instructions. Okay, so here's the, oh, look at this. I even have instructions down here too. Jesus. I forgot how much time I put in. So here we go. So here's your strategy up here. This is a passive growth portfolio. Got it. And they usually put their names here. Here's the version. There's the date in which it was first created. Got it. Over here, I got the companies. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 25 stocks. Okay. I got where they're domiciled. If you're going to use like Huawei or something like that, is Huawei traded as an ADR on the New York Stock Exchange? No. Okay, so it shouldn't be in there. Let's see. Oh, I I have Alibaba. So ADRs trade on the stock exchanges, so I can get exposure to Chinese tech companies if their shares are traded on our exchanges. Okay? And they have a ticker. So this is what, as you can see, these were broken up into different sectors, and then these are the companies that the analysts picked.
Is that okay that we choose some companies that, like, for example, Chinese companies, but that...
They have to be traded in the United States because I don't want to have us dealing with exchange rate risk.
Yeah, but publicly traded in the US.
Yeah, it has to be an ADR traded on an exchange.
Okay.
So if you want to do it maybe in Asia, I mean, this is a domestic class, but if you want to do international, here I have no problem with that. So you can do, let's say you want to do an Asian portfolio, Asia portfolio, just equities. You're going to have to find companies from Asian countries where their shares trade as ADRs on the American exchanges, either the NASDAQ or the New York Stock Exchange. So you can probably get to Korea, Japan, China, maybe some other. So you could do that if you wanted to. Or what some of my students were doing in my international is they were doing an emerging market portfolio. So they would do Eastern Europe, they would do Latin America, and they were doing Asia. Okay, that was kind of cool.
Yeah.
So they wanted to have X% exposure to Eastern Europe, X% exposure in Asia, X% exposure in Latin America. So you can pick the country, diversification, and then you could have sector diversification within each country. So you could design an international portfolio. Okay? And if you have any U.S. firms in your foreign portfolio, it's an international portfolio. If you don't have any U.S. companies in there and it's all foreign countries, then it's global. It's a global fund. Okay? There's a difference between the two. Okay? Then you have the industries that are laid out. You can use the NICS codes, the North American Industrial Classification System, for the industries. Again, you're going to probably do some research on these individually, right, on these companies. You're going to become very acquainted with these companies, okay? Not only at a portfolio level, but at an individual level, okay? Because we're going to value them too. Okay? Then you have the ticker right here, and then this right here. This is the stock price as of January 1st. Okay. As of January 1st. And then what we can do, you know, in like a month from now, what we can do is we have these forward tests. So what we can do is in these forward tests, we put in the stock price in a month from now, stock price in 2 months from now, stock price 3 months from now. And we're not going to be around in 4 months, but what it allows you to do is to test how the portfolio performed going forward. And we're going to calculate how the portfolio did going back in time. Okay? So we'll be able to test how you did.
Are we just doing companies, or can we do like ETFs or like bonds?
No, I want you to do companies. Okay. You can benchmark the performance against an ETF, but we're going to benchmark it against the S&P 500. Okay. No, because then you're layering on fees with ETFs. So if you're really creating a fund of funds, I want you to know how to create portfolios. Okay. But if you, what I found too, some of my students, which you might find in your with your foreign fund, is some of the stocks don't perform. Okay, never really performed. So you may have to find a substitute, swap out maybe 2 or 3 companies, because for some reason you had some duds in there. They just didn't perform over the long run, and drive down your performance. So let's go back to the master target portfolio. So this is what we're going to do. So once you put in the companies, right, in the domiciles, the sectors, and then these thick bars right here basically delineate the sectors. So as you can see, there's your defense, here's your healthcare, here's your consumer products, online retail, and financial services. Excuse me. Okay, so you're going to have a hypothetical $1 million portfolio. Okay? First thing you want to do is put in the stock prices as of January 1st. Do you guys, okay, I'm going to have to show you this. You need to write this down. So there's three main websites that I use. You can use NASDAQ.com. You probably want to write these down. NASDAQ.com. You need to write these down. NASDAQ.com. StockCharts.com. BigCharts.com. Yahoo Finance. I'll go through it. So, go to Yahoo. There's your Yahoo page. Go to Finance. Now, you're going to need Yahoo for the, when you start coming to class, the first 20 minutes, we'll say, where's the Dow, where's oil, where's gold, where's 10-year treasury yields, and where's the US dollar to the pound dollar to the euro. And they have it right here. Here's your S&P 500, there's the Dow, right there. That's a pretty good move today in the Dow. There's the NASDAQ, there's the Russell. Then you got the euro to the US dollar, you got the 10-year treasury yield, you got the VIX index, you got some currencies here, you even got cryptos. So Yahoo Finance is pretty good. I'm not a big fan of Yahoo Finance. So you can type in, you know, what is it? Here's your Amazon. So there's Amazon. So it's basically a dashboard. I can click on Max. It's a pretty good run, don't you think? I wish I would have bought Amazon, what, 10 years ago? Right? It's amazing. Usually we go back 3, but Yahoo is a pretty good place to go. I like StockCharts.com. And you're going to use the stock charts for the charts in the memos. Okay. What's Apple's ticker? AAPL. So you guys need to be following along in this. I'll go over it again. You need to follow along. So here's the chart, the daily chart. Looks like it's going back, maybe a year. For you technical security analysts, you're going to need to go over here to where it says fill the chart. Click on 3 years. Okay. Then you're going to update it. There's your 3-year chart. Okay. Then what you're going to do is you're going to go down here to simple moving average. You're going to change it to 10. You're going to change it to 30. And then you're going to go get one more. Simple moving average right there. And you're going to put in 50 and you're going to update it. Okay. So here's my chart. Is it in an upward trend? Has it been in an upward trend? looks like, it formed support right here, a resistance, broke out, looks like it traded in a range here, dipped here, it looks like it dipped right there, so that's a support right there, pricing support. Looks like it formed basically a resistance, which popped up, bouncing off the resistance line right there, then broke out, reached its peak, and blew through in a runaway pattern, just kept going, bottomed out, and its historic support right here, retraced where it was before, broke out to the upside. What's the trend? Upward trend. What do you think the stock price is going to continue to do? Go up. Right? And then these lines right here, we have a 10-day moving average, a 30-day moving average, and a 50-day moving average. And so the 50-day moving average is pretty smooth, right? But it's enough to basically capture the trend in the stock. Now the 10-day is very sensitive, okay? It's going to move, it's going to be more volatile, and it's going to move sooner than the 30-day, okay? But what happens is, as you can see, if we went back a little further, the 30-day and the 10-day are above the 50-day. So you would have bought it back here, and you would have been holding it all the way to here. And then all of a sudden the 10-day crossed the 50-day. That's your sell alert. Okay, that's your sell alert. And then when the 30-day crosses the 50-day, along with the 10-day, that is your sell signal. You sell the stock. Okay, yes.
What are all the moving averages like represent? What exactly are the moving averages like? What are they represent?
It smooths out the stock price volatility,
Okay.
the daily volatility, and it actually causes it to trend. And the trends are based on momentum. Okay, this is a pure technical trading system. Okay, based on momentum trading, just based off the charts. It's a rules-based technical trading methodology. The book talks about technical analysis, but does a really bad job of actually trying to use it to do anything useful. So what I did was I developed this system in like 1990 something, and I've been presenting it and giving it to my students over the last 15 to 20 years. I actually have a few students that have implemented this over the last 15, 20 years and have done extremely well in their investments. Okay. And this investment philosophy, this trading system, works best in qualified accounts. So you're going to go work for these companies. They're going to match or give you the opportunity to invest in a 401k, okay? And then you're going to be plowing a ton of money into the 401k, all right? And then when you decide to leave the company, you don't leave your 401k with the company, you roll the money over into a self-directed IRA managed by you and maybe another advisor. So as you continue to move through your career, you're accumulating all of this qualified money in a, am I bothering you? Okay. In a account that is tax deferred. Okay, tax deferred. So as the assets accumulate within the account, you're deferring your taxes. You will not pay any taxes or penalty prior to 59 and a half. You can leave the money in the account and you can trade the money in the account without incurring any capital gains. Okay, and then at 59 and a half, you can pull the money out and pay whatever income tax, the income tax level that you're at. But if you pull the money out at 59 and a half, you got to pay a 10% penalty along with the capital gains. But if you've been cranking it out, right, getting 20, 30% rate of return compounded over a 10-year period, and you need the money to go buy your Jag or your car or something, maybe even paying the penalty is not a big deal because you were trading your account tax-free for 10 years. Yes, sir.
Why do you use like 10, 30, 50 days?
I'll go through that right now. But I just gave you the strategy of how to accumulate $3 to $4 million over the next, 40 years. Maybe that's not a lot for some of you, but for some of us, we can live off that money, okay? And if you do the other stuff, you can get to $8 million pretty quickly too, over a 40-year period. Is that a cool thing? By the time you're 50 or 60, you got like $4 to $8 million in the bank. Yeah, totally, if you stick to the program, okay? So the reason why I used the 10, 30, and 50, okay, is because I've gone back and I've tested the moving averages. This seems to be the one that works the best, okay? I could shorten it and make it a more day trading type of thing, but I don't want to do that. I want to know that every time I buy and sell the stock, I'm going to make money, okay? I don't care to make like 100% that stuff. I just want to make my 10%, guaranteed. So what would you rather have? 20% with a probability of loss or 10% guaranteed? Got it. So the 10-year is very sensitive. Let me just finish the methodology a little bit. Because I'm going to have to go over this over and over again because some people aren't paying attention, okay? So I have to explain this over and over again to people. So the 10-day is very sensitive, and then the 30-day is not as sensitive as the 10-day and not as smooth as the 50-day, okay? So here you can see, here's the 50-day, the 10-day cross first, then the 30-day cross. The 10-day cross, that's the alert. When the 30-day crosses along with the 10, that's the signal to sell, okay? Then, so I would have pocketed all that, right? Not that. So then here, the 10 crosses the 50, that's my buy alert. Then the 30-day crosses along with the 10, that's my buy signal. Boom, 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 boom. All of a sudden the 10 crosses, alert, 30, sell signal, I sold there, I made that money, right? And then the 10, I'm not in the, I don't have a position right here. Then the 10-day crosses, the 30-day crosses, I'm now in the position, goes up, 10-day crosses, 30-day crosses, I'm out. And then here, it looks like the 10-day crossed, and then the 30-day did not cross, so I'm not in. Then we go to here, looks like the 10 crossed, then the 30, I'm in, I got my position. Looks like the 10 bounced off the 50, and the 30-day never crossed, so it held my position. I rode it all the way up to there, and I sold it there, and I bought it right there. Yep. Sold it there, bought it there, rode it up to there. Yeah, I'll take your question.
You're talking about 10-day crossing the 50-day, right?
Yeah, the 10 and the 30. The 10-day goes first, that's your alert. When the 10 and the 30-day cross, the 30-day makes the confirmation, that's your signal to either buy or sell. You stick to this program, you'll do just fine. You can trade it in a non-qualified account, but you're going to have to pay the capital gains every time you have a gain. You're going to have to pay the capital gains. If you put it into a self-directed IRA, you can trade these securities in a tax-deferred account where you don't incur any capital gains. But if you pull the money out before you're 59 and a half, you're going to pay a penalty and capital gains. If you pull the money out after 59 and a half, you don't pay any penalty, you just pay whatever the income is that you received upon sale. Just goes to your income and you pay your income tax. Okay, go ahead.
Why is it exactly that like on the 10 and 30-day cross 50, like that's like the time to buy that? Is it because
It's momentum.
Okay.
So basically the 10, when the 10-day crosses, it says, hey, there's momentum in the stock price. And then when the 30-day crosses, it's like we got momentum. So let's ride it. Okay.
And same with selling, it's like momentum's going the other way.
Yeah, it's like, oh shoot, it looks like we've just gotten an alert, that the stock price is going to correct. Oh, the 30-day just to confirm we're in a downward momentum. Okay, yep.
But if it's, so we're looking at the charts for 3 years, right?
Yep, just 3 years.
So the averages are averaging
They're moving averages.
the moving averages. So
That's correct.
for example, if it's
if it's gonna cross tomorrow, like, if we look at it like 3 years later today, look at the stock chart today, the moving average.
Yeah, what you're gonna do as analysts, the technical analysts, what they're gonna do is they're gonna print out this chart just like this. They're gonna identify exactly when they bought and sold these securities at what price. And then I'll show you, one of my students about a couple of years ago developed a profit loss statement where you basically put in the trades going back 3 years, and you basically calculate, you backtest your trading methodology to show that it's profitable. Now, almost every single team that I've been doing this over the last, I've been doing this almost 5 years, really about the last 3 years. I teach two of these courses per semester. Nobody's lost any money. And everybody's made at least $100,000 a year for the last 3 years, and $300,000 over a 3-year period of $1 million portfolio. On top of the money that they were making on their portfolio, they were trading their portfolio, but they also were managing their portfolio. So they were getting about 20% rate of return using 2 different types of methodologies.
What I was trying to ask was, because it's a 10-day moving average, are we gonna see, like tomorrow, if it's 10-day crosses the 50, are we gonna see tomorrow?
What you're doing is you're waiting. So right now, I am long Apple. I'm just holding on to it. If at some point in time, I know because stocks are volatile, Apple price is going to come down. And the 10 day is going to cross the 50, that's going to be my alert. And when the 30 day crosses along with the 10, that's my confirmation, that's my sell signal. Okay. And then what we'll do is we'll talk about later on, instead of just buying and selling the stocks, we can buy the stock on margin, or we can go short. So now I can even enhance the return on the portfolio by taking on risk in my trading strategies. And then the ultimate dynamic system would be to, when you get the signals to buy and sell, you're not buying and selling, you're not buying on margins going short the stock. You're actually buying or writing puts and call options. We couldn't do it. We tried to do it. We tried to, no, I haven't done it in the class yet, because that's really quite advanced, but I did. One of my students from 15 years ago has been trading the system for 15 years, and he tried to use option contracts, and just lost his shirt on the puts, okay, because they're expensive. Yeah. So I think it could be done, but he didn't really pursue it. You know, and he wasn't really trading enough to be able to understand how to unload and unwind his positions to mitigate his losses. And you guys are going to know about all this stuff, because you're going to be studying derivatives in this class. Okay? We're going to be talking about it. All right. So that's the technical trading system. Okay. So you're going to get the stock prices from here, and the technicians are going to be using this platform. Okay? And you're going to be using this chart if you're going to be in your memos too. You can use them.
How do people lose money using technical analysis? Is it just like different moving averages?
There's other types of, if you go to the course website, you go back, and where is that from? Oh, here we go. Technicians, technical analysts. You see this technical analysis resources right here? Click on that. technicians are gonna need to read these resources. If you wanna be an expert in technical analysis, and you wanna be an expert in trading, I basically went through my technical securities analyst books, and I basically pulled out the chapters that I thought were the most important, relevant in learning technical trading techniques. Okay? So these are that's the literature. So you can lose money by using technical analysis, using other types of technical analytics. The moving average crossover system is just one method. Okay? I like it because it's simple and it works. So why screw with it, right? So here's your test question. Have you ever heard of the fable, Aesop's fable? You heard of that fable? Aesop's fable? You ever heard of it? No? The story about the hare and the tortoise that ran a race, right? Who won? The hare or the tortoise? The tortoise. So what do you want to be? The hare or the tortoise? I'm going to be the tortoise. Well, yeah, but I'm just saying.
Yeah.
The tortoise won, right? Why did the tortoise win? Because he was very methodical, right? He knew what he was doing. He stayed focused on the race. The hare ran out. You know, he thought he was going to win. He ends up getting exhausted, passing out under a tree. The tortoise goes by, wins the race. So what do you want to be? Be a tortoise. So the technicians are going to have to, and you're going to become an expert. So let's go back to the worksheet. So you get your stock prices for January, and you got to follow this. So you put your stock prices, you need to follow here because you're going to screw it up, okay? So you put your stock prices here as of January 1st, right?
2020.
Huh?
2020 or 2019? 2020.
January 1st, 2020. January 1st, 2020. January 1st, 2020.
Yeah, okay.
Got it, okay? Then what you're going to do is you're going to come over here, and you're going to put in the market caps, okay? Or sales, or revenues. These are the weighting factors, okay? This is beta investing. This is called smart beta. These are factors. These are the factor weights. So your portfolio weights based on some factor. Okay? I could use total market cap, okay? The value of the debt and the equity. I could use that as a scaling factor. I could use just the value of the equity if I want to. And use that as a scaling factor. I could use revenue. I could use sales. I could use earnings. I could use an accounting metric, or I could use some other type of metric. So what you end up doing is you end up putting the market caps in here, and what it does is it automatically calculates the weights for the stock. Okay? So this is basically your initial weight. Well, if I know I'm going to buy 4% of JP Morgan, I basically buy 4% of a million, which comes up with $42,000. I divide it by the current stock price, and I get the number of shares that I'm going to invest in. Right? So this is a very simple model. Yes, sir.
I didn't quite get it. So that's basically based off the market cap percentage.
Yeah, so these are the weights. These are the scaling factors. Right? So what we actually did here, we usually do this later, but we did it here, is we put in the market caps, and then we went ahead and set the minimum and maximum exposures. I played with the weights to recalibrate, because we didn't want to have less than 2% in any one stock. And we didn't want to have any more than, I think, 9 or 10% in any one stock. So we capped it. We set minimums and maximums. Because if I had it unconstrained, Apple and Amazon and those guys would have like 15, 20% of the total portfolio, which means the portfolio performance would be driven by one or two stocks. And I didn't want that. Okay, we wanted more diversification. So once you play with these and get the weight, the scaling factors set, it's going to calculate the dollar amounts you're going to invest divided by the stock price is going to give you the number of shares. Then what you do, pretty simple, if you haven't messed it up yet, is you go back to January of 1919, and you put in the prices. Okay? And what it does is it calculates your 1-year backtest return. Okay? And then you calculate the 1-year return on the S&P 500, and it calculates your alpha. So 6.8% or 680 basis point alpha, is that good? Are you happy? Can you raise capital? Is 1 year a good backtest period to show long-term outperformance?
No.
So we gotta go back 3 years. So we go back 3 years. We go back to January of what am I doing? 1817, January 2017. Stick in the stock price. I don't have to do anything because the initial shares that I invested in the company don't change. I didn't asset rebalance or anything. This is a very simplistic, back testing model, but it shows performance. Okay, it's good enough. I didn't want to make things too complicated for me because life is too complicated as it is. So if you go back 3 years, you calculate the average annual compound growth rate for the portfolio, and it was 17%. The S&P 500 did 9.8. The portfolio did 7.2%, beat the S&P 500 by 7.2 percentage points of 722 basis points consistently over the last 3 years. Is that a long enough time period? No. So you gotta go back. Then we went back 5 years. Very easy, super easy. So what am I doing? 19, 18, 17, 16, 15, January 15. Put the money, put the dollar signs in. Average annual compound growth rate over a 5-year period was 19.3%. Is that pretty good? What did the S&P do? 12.8. Still got 653, basis points of alpha. That's pretty amazing. Either I'm doing something wrong, or I basically just said, hey, if you invested $1 million, at this, 5 years ago, what was the performance of the portfolio? If you just did a buy and hold strategy. I think that was pretty good. And then the one that's really the most important that I do when I'm in back testing portfolios or back testing ETFs or mutual fund, I want to look at a 10-year. Now the problem with the 10-year is that what was happening in, 2010? What's happened to the stock market since 2010? What's happened to the stock market since 2010? It's only gone up, right? It's had some convulsions, but it basically is only gone up. To get a better picture, I would have wanted to go back 15 or 20 years, because then I would have captured a recession in there, or a financial crisis, and see if my portfolio can still hold on. Okay? But the average annual compound growth rate was 13.4. So under the rule of 72, how long would it take me to double my portfolio? Am I just boring you? I guess. Up here. Under the rule of 72, how long would it take me if I was getting 13% rate of return? So 72 divided by 13.
5.37.
Is that good?
Yes.
Would you be happy if you could double your portfolio in 5 years?
Yes.
And then look at the Alpha 600. So that's pretty good portfolio. And then you got to go back and say, well, why did it outperform? Well, it outperformed because of 2 reasons. One, the securities analysts picked really good companies. That's one attribution. The other one was not only did they pick good companies, but they actually picked good sectors. So it was done when you do the attribution analysis, you would have said, this is how much of the return was contributed to stock picking. This was the amount of return that was due to sector allocation. Okay. So that's pretty simple, right? So can you guys do that? Yeah. Pick the stocks, talk about stocks, sector allocation, build a portfolio, put the data in, back test it. Pretty simple.
For stock prices, we're gonna use the end of the day. Stock.
It doesn't matter, because there's not gonna be any material difference. You can use that in a day. It doesn't matter, stocks don't move that much in one day. They do over time, but not that much in one day. So it doesn't matter, whatever you want. How am I doing on this? Boring? Where were we? Oh, here's the analytics software. How much time do I have?
About an hour.
So here's the second one. Right here. This is the portfolio optimization worksheet. Okay. This one took me 2 months to program. Okay. For this class. So the Bodie came to Marcus, the book, gave me a template, and then I re-engineered it. I used a lot of the functions in it, and then expanded it. Okay.
In what book?
The Bodie came to Marcus book, the one for this class,
Okay.
which is like the Bible investments book. I could use other ones, but I was familiar with this one, and they do have some really good templates. So I basically took the template from the book and then re-engineered it. So it was a little bit more relevant. So see if you can pull that one up. Now, there's a trick to this. There's a trick to this worksheet. Okay, so there's a trick to this worksheet. You can't bring it up in Google Sheets. Did you hear what I said? You cannot use Google Sheets. Okay? Because the optimization engine and the factorial calculations that it goes through using the optimization procedure, which was the procedure that Harry Markowitz wrote in 1957. Okay? He wrote the mathematics. They couldn't solve it. It wasn't until the 1980s that the desktop and the computer technologies were advanced enough to actually run his factorial calculations, okay, and do the optimizations. So Excel can do it, but you got to use 365. Okay, and the person that is the curator of this optimization worksheet, you can't go back and forth between Google Sheets and Excel, and you can't share it, okay, because you'll blow it out, and then you have to go through everything all over again. So it's a really sensitive. You got to have at least Microsoft 10, to run the OS, the operating system, and you got to designate somebody that's going to do it, okay? Because if you start playing around with it, it's going to blow up. All right. So the key is this stock portfolio optimization worksheet right here. Now I do have the solver instructions. Okay? One of my students last semester, I said, he was the portfolio manager. I said, how did it go? He said, it went pretty well. I said, how did you solve it so quickly? Because it was done in like a week or less. I said, how'd you do it so fast? He said, I just read the instructions. Crazy, isn't it? Just read the instructions. So there's some, what else do I have there? So we have the instructions, we got the companies, we got the portfolio optimization worksheet. Okay, it'll come. Okay, here we go. So we're doing the portfolio optimization worksheet. Did you guys pull it up?
Yeah.
Don't forget to save. Okay, here we go. All right. So all of these, this is a table, everything's pulled. Okay. Everything's pulled. Okay. So don't start hard coding and doing stuff. Start messing with the logic, it's going to blow So I got standard deviation, variance, I got correlation, covariance. I got mean and median 5-year annualized returns. Okay. And then we have our estimated, we're gonna do 2020 estimate, so you gotta change it to 2019. And then you're gonna have to project out what you think the stock price is gonna appreciate by over the next year. Okay. And plug that in. Do you think that the 5-year mean and median is going to be a good indication of the expected return going forward? Yeah, so it should be a guide. And then you're going to study the stocks and you're going to figure out what is most probable, right? I mean, I didn't do Apple. Apple's done like 22%, 25% average annual rates of return over the last 5 years. You know, I said, you know, they may do like 22. And I don't know what it's done this year. I think we're right. They probably did like 22 in 19. So we kind of figured out what it was. But they do things. Okay, so that's like the first table. And then here's your covariance matrix. That's also pulled. Okay, which is also pulled. All right. Then you go down here. And what you're going to do is you're going to run, there's 3 optimizations, okay, 3 macros that do optimizations in this Excel. You're going to run the first optimization, which is your minimum variance portfolio. Then what you're going to do is you're going to run, what you've done is you've taken from your portfolio, you're going to take the highest return and the lowest return, and then figure out the spread divided by 15, and then create the return increments, okay? And every time you run that optimization, it's going to kick out these weights, okay? Then you're going to run the next optimization on the return. It's going to kick out the weights, the next, the next, the next. So you run through 15 iterations, calculating the variance, of the standard deviation of the portfolio. Okay? And then the last thing you're going to do, and I'll go over this like 3 more times, but I'm walking you through it now, so at least you're exposed to it. And then the last optimization, so you run 16 optimizations, the 17th optimization traces out the capital allocation one. Okay? So this is the dynamic, active portfolio approach. Oh, look, instructions, screenshots, baby steps. Okay? And then at the end of the day, your efficient frontier, here's your capital allocation line. Here's your efficient frontier. Here's a portfolio that's tangent to the capital allocation line that provides the highest return to risk ratio. So that's going to be your portfolio. These are all feasible portfolios that you can construct. This one's all Apple, 100% Apple. And then this is some variation across the other 25. And then these are infeasible portfolios, right? Why would I buy a portfolio of higher risk, higher standard deviation, and lower return? I wouldn't. So I could short these if I wanted to, but really these are the real feasible portfolios that you could construct and then sell as a strategy to your clients if you wanted to. Then what you do is you identify the portfolio that provides the highest return to risk ratio, return divided by standard deviation. This is the portfolio that's giving you the highest unit of return per unit of risk. So then what you do is you go back into your backtest portfolio worksheet and you start messing with these numbers to replicate the weights that you derived from your optimization procedure and backtest your active portfolio strategy. See how it did. Okay? Then what you do is you take these weights, you study these weights. You look at these weights right here, those weights, and then you, the technician, says, I've identified 5 stocks that I think are going to continue their upward momentum over the next year, and so we're going to overweight those a little bit. I recommend that we overweight them a little bit. And then the fundamental securities analyst is gonna go. I ran through the fundamental securities analysis, which I'll show you in a minute. And here's the companies that are showing the biggest premium over their current stock price over the next year, and we should overweight those two. Underweight the ones that we think are gonna trade at a discount. We overweight the ones that are gonna trade at a premium. We use the passive portfolio allocations, the active to come up. So you're going through and you're building the target portfolio. And then you take all that information, come up with a final weighting scheme, and you come up with a target portfolio. And then back test that. So you came up with 3 portfolios. You came up with a technical trading system, recommendation, another way to make money, and you used the fundamental securities analysis to then make stock recommendation and stock picks. So there's another. So you basically have 4 products, 4 strategies that you can sell into the marketplace and make money for them and yourself. Okay. I want to show you what you're going to be working on, so you can think about it. Okay. Not wait till a month from now or 2 weeks from now to get to it. I like to get to it like right now. Let's do it. Let's do it now, so you can think about it. Okay. So the next is the intrinsic valuation worksheet. Okay. Another one of my students. I did this one. I built out this one, built out that one, did the intrinsic valuation. So one of my students did that one. And then the other one did the profit loss for the technical analysis. Okay. So this one, this master sheet right here, this is just an example. Okay, it's not tied to anything, it's just an example. Okay. Then you have here some company inputs. Now, this stocks 1 through 6, 7 to 12, 13 to 18, 19 to 24, and 25. These are all linked, to the other spreadsheets. So these are the sheets that you print out to put in the report. So we already have the stuff. There's worksheets, and then there's print report sheets. So he designed the whole thing already for you. This guy was amazing. So there's Apple. Okay. So basically we have the printout over here, and here's the worksheet right here. Okay. And the fundamental securities analysts, we're going to be using 4 intrinsic valuation methodologies. Perpetuity, that assumes that the stock price is going to remain flat forever. Ordinary growth, which means that the earnings are going to grow at a constant rate forever. We're going to use the PE multiple or the multiple approach to calculate the intrinsic value. And we're going to use the discounted cash flow. Okay, so we're going to use the 4, and we're going to come up with there's already a weighting scheme. Obviously, DCF and multiple should get the bigger, most of the weights, because perpetuity and ordinary growth are fairly simplistic. Okay. So what you're going to do, see, I got 2017. We're going to want to use 2020 earnings per share, right? Because I want to use stocks are forward-looking, so I want to go back and I want to look at earnings per share growth rates for these stocks and make a projection on what you think the stock price is going to, earnings are going to grow out for next year, at the end of next year. Okay? So for 2021. Okay? So you put in your earnings per share for 2021. What I did was I just came up with 3 sensitivities for expected returns. Okay? My expected return on the portfolio, I require, for all the stocks that I invest in, I require an expected return of 8 to 10%. So I'm going to use 8%, 9%, and 10% as the discount rate sensitivities to discount the earnings. Okay. So for the perpetuity, it's easy. You just take the 2021 earnings per share and you divide by 0.08, 0.09, 0.10, and it kicks out the intrinsic value, assuming that the stock price is going to remain constant forever. Then the second scenario is you take the Gordon growth, it takes the expected return minus the constant growth rate. So 8 minus 1% is what, 0.07. 0.07 divided by 2021. EPS is going to kick out the valuation in the first cell. So what you're doing is you're calculating an intrinsic valuation matrix for the Gordon growth law. Now what's happened over the last couple quarters that I've been working with students, I really worked with the fundamental securities analysts, on conducting the analysis, so we worked really closely together, along with the technicians too, and the portfolio managers. So I worked really closely with everybody. What we found is that the valuations, the intrinsic valuations, have been too low compared to the current stock price. So what we figured, what we would do, is we would say to ourselves, do you think the stock price is going to go up or down next year? What do you think? Probably Apple's probably going to go up, right? So what we did was we started, our discount rates are fine, because that's my required return, so we don't have to mess with that. The problem is we're underestimating the earnings growth, constant growth rates of the earnings. So what we did is we started taking them up to get close to the current stock price in that set. And then we said, okay, we're gonna maybe adjust the growth rates a little bit and then make sure that it's at some kind of premium. So what we were actually doing, and this is really fascinating because I didn't know this spreadsheet was gonna actually do this. If I can engineer the growth rates to the current stock price, what I can do is I can see what the stock analysts and the investors are assuming about earnings growth, constant growth expectations for Apple. That's extremely valuable. I can back into the growth rates by using the Gordon growth to basically adjust these growth rates up to get to the current stock price. And those growth rate sensitivities will tell me what the market thinks earnings growth rate for Apple is going to be. That's extremely powerful. Okay. And then the other one is the PE multiple. Okay. Price, the stock divided by the earnings per share. Okay. Especially the forward-looking. You can do forward-looking PE. That's even better. So you look at the PE multiple in the most recent period. You look at where the multiple is today. You look at the multiple against the peer group, and you make a projected earnings per PE multiple for next year. So you multiply. We felt that the PE multiples were going to range between 14 and 12. The current PE at this time was 12. We thought that there would be multiple expansion, so we took this one to 13. We did 14, 13. So we took it up, one higher than the current multiple. The stock price has gone up, hasn't it? So we did get multiple expansion. Okay. So the earnings per share projections stayed the same. The stock price went up, our multiple went up. Okay. So then you take the multiple, multiply by the 2021 earnings per share. It's going to kick out the intrinsic value using the PE or the multiple approach. Got it. Then what we do is we got the 21, 22, 23, 24, 25, 26. We basically got the starting earnings per share. We basically put in the earnings per share growth rate projections over the holding period. We calculate the terminal value using the Gordon growth problem. Add it to the last year's cash flow, discount it back at the 3 discount rate scenarios. Boom, we get our intrinsic value using the discounted cash flow. Calculate the weighted stock price. Our intrinsic value is $189.99. The current price at this time was $163. We had a premium of 60%. We overweighted Apple in our portfolio because we felt the stock price was going to go up 16% over the next year, and it did.
How do you find earnings per share growth rate?
You got to go do the Yahoo Finance, Mergent, S&P, Advantage, Value Line, you can use Merchant. You can go talk to, what's her name, Julie, the reference librarian over at the librarian. I'll actually show you too. I'll do a Merchant demonstration and show you how to pull a lot of the data down so you can do the analysis. Okay. And then you can go find, analyst expectations of next year's earnings per share as a guide. Okay, so you can go find other research to kind of give you what the project. These guys thought that the earnings per share growth rate was going to slow, and then it was going to re-accelerate as new products were introduced. And then they thought that we were going to slow down again because they were forecasting a mild recession between 2020 and 2023, so they brought down the growth rates. So they were looking at historical growth rates as a guide. They were looking at what the earnings and analyst conference calls and projections and new product launches and new sales and new phones would be. They were looking at overall business cycle and market cycle to come up with their holding period projections on the growth rates. Okay. All right. Then and you do it for all the stocks. So you guys are gonna be working on these. Technical analysts. Who's the technical analyst? Okay, so you technicians are going to go back and print out all those charts with the 10, 30, 50 day moving average going back for 3 years. Then what you're going to do is you're going to put in 3 years ago what you bought it at, and then what you sold it at based on the technical signals. And it's going to calculate the profit. Okay. And then what it does is you're going to have to make sure that these sums, these sums here, these ranges here are capturing the years. So maybe you had 2 trades in 1 year. That's the amount of money you made that year. In year 2, you had X number of trades. You're going to make sure that these things are summing up correctly by year. Okay, and then the 3rd year. So in this case, these guys made on average about on the $1 million portfolio based on the shares that you guys came up with. You can use the target, or you can use the passive portfolio number of shares. They made over the 3 years $242,000. On average, about $80,000 a year on the $1 million. And then this is how much money they made during that time period. So they did pretty good. So that's what the technicians are going to do. Okay. And then lastly, I think I'm burning out here. And if anybody wants to work with me on this one, I'm trying to get to solving this worksheet for a couple of years, but I just can't find the right analyst to work with me to do it the right way. So here, so the fundamental securities analyst, here's the stocks. Here's your earnings per share for 21, 22, 23. Here's your intrinsic values in perpetuity, Gordon growth multiple, and DCF. This is your weighted average intrinsic value using your final intrinsic valuation. Here's the current stock price. If you divide this by this, it's going to take the percentage change. It's going to give you either a premium or a discount. And then what you do is you sort it by premium to discount from high to low. So these are the ones you're going to sell or you're going to underweight in the portfolio. These are the ones you're going to buy or overweight at the top. And then this one just gives you, your weights, what your weight is going to be in these individuals. This is an extremely powerful chart because it's used not only to over and underweight the individual securities in your portfolio to yield enhance, but it also is is research that we can sell to our clients as research reports and recommendations and make money that way too. And I can trade this stuff myself in our own proprietary trading units. We can take these recommendations and the discretionary accounts that we manage, make those recommendations to our clients, and then make the recommendations and sell the research to our clients. So we're making money all over the place doing this stuff. And then the last one is the one I could never get anybody to work with me on. Maybe it's just because, at the end of the semester, they're pretty fun. And it's really pretty simple. You've got the companies, you got the PE ratio, the ROE, ROA, dividend yield, leverage metric, beta. These are just, you could use any key financial ratios to conduct the overall financial condition and position of the firm. So it's another way of doing fundamental securities analysis before you before you invest in a company, you're going to want to conduct financial ratio analysis to look at the financial ratios to see if they're solid. What I want to do is, since I've already calculated, the averages of these things, if I also calculate the standard deviation of these things, what I can do is I can take the actual for like Avalon Bay, subtract out the average, take the average for all of them, subtract the average, and divide it by the standard deviation, and create what's called a z-score. Okay, it's a standardized metric. All right, and I create another sheet, and I got z-scores for all of these financial ratios. Then what I can do is I can add up z-scores and then resort the companies by the z-score index. And the ones that basically rank at the top have the best financial ratios. And the ones at the bottom have the weakest financial ratios. And I can even weight these metrics to create a weighted index and resort the companies and overweight the ones at the top and underweight the ones at the bottom based on the financial ratio analysis. Okay. So that's basically what we're doing in class. Okay. We got some other stuff I wanted to show you exactly what we're doing so that you can get started on the static portfolio. Okay. And then what we'll do is I'll teach you the memos. We need to do it tonight. We'll go through the exam, but I wanted to get you kick-started on the application and start doing some real life. Any questions? Okay. I'm going to end it there because I'm totally fried. But I think that was a good primer, good orientation. And then we'll do the memos, the exams, and then at some point we'll really start working on this and pushing it through. Yeah, we'll do that. Yeah. Because I don't want you going off and doing it. I want to check in. On the theory, really the application. Yeah.